I'm Taylor Riggs. This is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up.
It's a very complex project, and as you say, it's risky.
Facebook CEO Mark Zuckerberg describes Libra as complex and risky. More on his testimony in front of a House panel Wednesday on Capitol Hill. Plus, Amazon's big bet. Did the e-commerce giant's $800 million investment into one-day delivery pay off in the latest earnings report? Details ahead. And Twitter misses third quarter revenue estimates. We find out why new user growth did not translate into ad sales. Facebook dominated the week in tech, with CEO Mark Zuckerberg defending his social network before U.S. Congress on Wednesday. What was scheduled as a hearing on the cryptocurrency Libra before a House committee also included issues like antitrust and privacy.
Is it a currency? Are you a bank? What is this association?
It's a very complex project, and as you say, it's risky.
Do you consider Libra to be money?
I consider Libra to be a payment system.
So it's like me having my money in Wells Fargo Bank.
You could think about it that way.
Okay.
Although we're not a bank, we're not applying for a bank charter. I think that the right analogy.
But that's the problem.
This is a
Mr. Zuckerberg. That's the problem. That's what we're facing here.
My commitment is that we're not going to launch the Libra payment system here or anywhere else around the world until we get the approval from FSOC and the other relevant U.S. financial regulators.
The American competitiveness angle and the competition with China is a national security issue.
In China especially, they immediately kicked off this public-private partnership with some of their biggest companies in order to race to try to build a system like this quickly.
Will it be possible to conduct anonymous transaction using Libra? There's a whole host of problems. So will Libra allow anonymous transactions?
I think that it is an open question.
It's pretty hard to stop anonymous trading. Have I missed something there?
Congressman, I think that this is probably more of a policy issue and question.
No, but as your code currently exists, can you transact anonymously with Libra?
Congressman, it certainly would be possible to build a system that would allow that.
I want to ask you a very simple question. Mr. Zuckerberg, are you a capitalist or are you a socialist?
Congressman, I would definitely consider myself a capitalist.
Frankly, I'm not sure that we've learned anything new here.
Bloomberg's Kurt Wagner was at Wednesday's hearing and had this to say about it.
People still do not trust Facebook. I think that was the overarching theme from a lot of the questions that we heard today. A lot of the feedback from the members of Congress was basically pointing out things that Facebook has done wrong in the past and asking the question, given your track record, why should we trust you with Libra, with people's money, with a new cryptocurrency? At the end, I think it was Representative McHenry, after almost 6 hours of questions and testimony, he says, I'm not sure we learned anything new here. And it was, a little bit of a unfair blanket statement. But at the same time, I think despite the fact that we had all this time to hear from Mark Zuckerberg, we didn't really walk away with a bunch of big questions answered.
Kurt, when pressed on why we should trust Facebook, what was his response?
Facebook is just one of 21 different companies that are now overseeing the Libra cryptocurrency. So Facebook is basically putting out there that, hey, we are not the only people making the decision here. We want to work with regulators. We want you to tell us how this is going to work, and it's not going to be only our call. That's obviously a very important element of all this, right? Because for those people who do think Facebook has too much power or who think Facebook cannot be trusted, the idea that they're bringing others into the fold or that they're going to be following rules that someone else creates, that is going to give them a lot more flexibility to actually get this thing off the ground.
And Kurt, we heard him also bring in China and basically saying if we don't do this, China will, and so we have to do this to get ahead. We have a soundbite from what Zuckerberg was saying about China. Take a listen.
As soon as we put out this white paper on Libra, what we saw was in China especially, they immediately kicked off this public-private partnership with some of their biggest companies in order to race to try to build a system like this quickly, a digital renminbi that they could use as part of their Belt and Road initiative, their kind of foreign and economic policy to grow influence throughout Asia and Africa and other areas.
Kurt, is Zuckerberg right in bringing in China here, or is he just playing to all of our fears about China's taking over?
I think there's probably some validity to this concern, right? This idea that there are companies and the government in China that really wants to accomplish a similar problem, and they have the ability, the technical ability probably, to do something like this. I do think that this is a very convenient argument to make, especially right now and especially in front of this Congress, given all the issues that we're dealing with China, with the trade war and all of that. It does seem like now is the time to kind of play up this fear that maybe China is the real threat here. And we heard him say this last week, too, when he gave a speech at Georgetown about free expression. He also talked about the internet rules that they have in China. And if tech companies like Facebook don't support free speech, you may look up one day and realize that that's gone from the internet because Chinese companies are controlling it. So he has played on this China fear before.
That was Bloomberg Technology's Kurt Wagner. For more analysis on the hearings and the issues facing Libra in general, I got insight from Karen Petru. She's managing partner and co-founder of Federal Financial Analytics, and Sarah Miller, deputy director of the Open Markets Institute.
Oh, I think nothing was answered other than the commitment that Libra will get regulatory clearances before launching, but from whom, how, for what, and whether the product exists after that, I think is very much still to be determined. It was a promise, but not one with any specifics, any timing, or in my opinion, any clarity.
And Sarah, are the problems here not about Libra, but the fact that it's Libra and Facebook, and that Facebook's name is attached to this project?
I think that certainly doesn't help. I mean, from the hearing today, there are two takeaways in my view. One is that Libra is toast. Number two is that Mark Zuckerberg got roasted. He did not do himself any favors here. But the idea that regulators in the U.S. or around the world are going to allow Mark Zuckerberg to potentially undermine the entire U.S. financial system is highly unlikely at this point. So I don't think he did himself any favors at all. And it just opened him up to being a punching bag from both the right and the left on a whole host of issues that went far beyond Libra.
Karen, you chuckled a little bit when Sarah said that Libra was toast. Do you agree that Libra feels a little bit dead on arrival?
Well, I've said before that I think this is the worst product launch ever, and that's counting the new Coke. And the reason for that is because they didn't understand a very fundamental fact. The payment system, currency, financial transaction, it's about other people's money. Social media raises a lot of privacy and many other issues, but you're putting economic equality on the line when you start taking other people's money. And I don't think to this day Mark Zuckerberg or Facebook get that. This is different. And Congress told him that again today from both sides of the aisle, as Sarah said. And I'm not really sure they get it now.
That was part of my conversation with Karen Petru, managing partner and co-founder of Federal Financial Analytics, and Sarah Miller, deputy director of the Open Markets Institute. And coming up, an earnings bonanza this week. We begin with the path to profitability. Tesla roars with a surprise profit in the third quarter, impressing investors. We hear from an analyst. Plus, Wall Street expected growth from Amazon this earnings season. Did they deliver? And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. Tesla shares spiked in after-hours trading Wednesday after the company posted a surprise third-quarter profit. Tesla CEO Elon Musk took to Twitter less than an hour later, saying he was, quote, super proud of the Tesla team for great execution and the support of Tesla customers is greatly appreciated. With more on the earnings per share picture, margins, and what the company says about China, I spoke with Dan Ives, analyst at Wedbush Securities.
If you look at the margins of profitability, that's the major feather in the cap for the bulls. And I think that's a surprise. I mean, this is really something that Musk and Fremont need to deliver here. Margins are the focus and profitability. And this is something where if they can maintain this would be a potential game changer for them going forward.
But Dan, the problem is you can't cut your way to growth. So if you're seeing a top line decline for the first time since 2012, is it sustainable to cut your way to growth?
Look, in our opinion, that's going to be the challenge for them to navigate profitability while they're trying to get the growth, given what's happening in China. That's going to be the key in the conference call. A major short covering that you're going to see, but that's really the key here for Musk and Tesla to navigate going forward.
Dan, part of the profit picture and the revenue picture has been the composition that we've talked about between the S, the X, and the Y, and all of those, and then the Model 3, which is that lower margin. How do you feel about the composition?
It's going to be, look, with Model 3, given where margins are, that's going to be the difficulty to get there from a margin perspective, given what's happened in S and X. Y is going to be key going to 2020. That'll be a big focus on the conference call, as well as China and the Giga 3 build-out.
That was Dan Ives of Wedbush. Amazon reported its third quarter earnings Thursday, and one of the big indicators of growth was expected to be the company's free one-day delivery. For perspective on that and more, I turn to Bloomberg Intelligence Jitendra Woral and JumpShot CEO Darren Baker.
Actually, going to the quarter, there was a lot of angst around cost because we knew one-day shipping would bring some variability in cost with it temporarily, albeit for a couple of quarters, and that variability sort of played out. Also, they are spending a lot on content, AWS, advertising division. So there is a spending cycle that's going on with a hint of variability here and there, which actually makes next couple of quarters the anxiety would continue from a cost perspective. But where it is paying off, it's like you're clearly seeing a sales impact happening on the retail side because of one-day shipping. It will pay off longer term in terms of market share, in terms of revenue growth. But as far as cost variability is concerned, we think that'll continue for a few quarters.
Darren, are you concerned about the rate of spending, the right-hand side of that income statement, all of those expenses and its impact on the bottom line? Or is this one quarter and we should brush it off?
I don't think it's one quarter, but it doesn't concern me that much. I think what you've seen over the course of the last couple of years was Amazon kind of proved to the market that they could drive profitability, and they pulled unprofitable products off. They emphasized AWS and advertising. I think what you've seen in 2019 is that increased spending on the things that are going to drive more customers to use Amazon all over the place. One-day shipping, getting those products, no matter what they are, back on the shelf. And so I think what you're going to see over time is their strategy is world domination. Anywhere you can buy a product, anywhere online, they want to offer that to you, and they'll figure out how to monetize it in other ways, advertising, AWS.
And is market share dominance the right strategy, even though it's not translating down to the bottom line?
I mean, they've proven that it does work. If they want it to work, it will work. But at the same time, with AWS specifically, if you look at the growth rate, there are concerns about growth slowing. It's a run rate of $36 billion. They are the market share leaders in infrastructure as a service. So that adjustment needs to be happening in terms of what the expectation should be for that revenue size, but that doesn't concern us. If you actually look at advertising division, you saw a growth acceleration this quarter, and what we feel happening is now advertising will slowly take the center stage as AWS plays more of a mature role.
So we've talked about AWS. I'm showing a chart here in our terminal for our Bloomberg customers here showing the revenue growth for Amazon Web Services. Darren, how concerned are we that this is slowing, and it is slowing multiple quarters in a row?
Yeah, I think there is concern that it's slowing, but I still think there's a big market out there for them to continue to go after. And I believe that Microsoft is doing a good job and Google is investing heavily in web services, but I think Amazon's got a big leg up because of its deep customer relationships.
And Jitendra, so he brought up Microsoft yesterday. I was speaking with the Jefferies analyst, and he said Microsoft, of anyone in their Azure product, will structurally benefit more from the shift to the cloud, even more so than Amazon. Are we beginning to see Amazon Web Services and there's some of their cloud products start to lose a little bit of that market share?
I'm not sure about that in terms of Amazon losing. Microsoft winning, yes. And that's the hybrid cloud strategy that they have been successfully executing against, and that should continue to benefit them. And, like you said, the end market here keeps growing at a healthy pace, and there's enough room for three players. But Google has also stepped its game up quite a bit in the last couple of quarters, really, and we're going to see those results. But at the same time, I think Amazon can hold their growth over there in that 30% plus range, but advertising, disclosure of advertising is going to become more and more critical. This business can be significantly bigger than what it is right now. They have the opportunity. They have better targeting in many ways because they are almost just before the decision is sort of placed. So they have a very good ROI potential. And as this business gets bigger, they might pull the disclosure card. You remember how AWS was disclosed in 2015 and suddenly the profitability perspective for the company was changed. So now the weight is going to shift more and more on advertising as AWS plays more of a defensive and holding.
So if that were true, why are we looking at a lower than forecast fourth quarter top line revenue if they have that advertising power muscle?
I think they're probably looking at consumer spending and making sure that they are being conservative for what is usually a really big holiday season for them. But I do agree that when it comes to the areas of market share that they're growing and the investments that they're making in that, like shipping, and then their ability to just juice more revenue out of that same transaction through advertising, I think they're going to do. They have a lot more opportunity.
That was Bloomberg Intelligence's Jitendra Warral and JumpShot CEO Darren Baker. Now, meantime, Snap posted strong user growth in its latest earnings report card. The social media company said there were 210 million daily active users of its photo messaging app, Snapchat, in the third quarter. Shares of Snap have more than doubled in value so far this year. Michael Levine of Pivotal Research joined us right after the analyst call.
I think there was maybe a little bit of disappointment from shorter-term investors with regards to there being a bit of deceleration in Q4 relative to Q3. And I feel like the company addressed it pretty well. I mean, the U.S. growth, which I think this is still viewed as largely being a more U.S.-centric story, was extremely strong. And they're adding a lot more of the users in rest of world, so there's a little bit of a lag. But it feels like they're getting the right pieces in place with regards to monetization.
And are you happy with the updated guidance you're getting from management on the call so far?
Yeah, I think they're fabulous results. I mean, there had been a wall of worry with regards to user growth. The user numbers were, as you mentioned, fabulous for the quarter. Outlook was very strong as well. And I think when you talk to the company, and at this point I'd say ownership has probably been a bit more hedge fund centric in nature. They've definitely been spending more time with the long only community. And the feedback that I've heard is basically, it's great. We love to own stocks when they jump 20%. We don't like owning them when they basically go down 20%. So I think they're doing a much more effective job tightening up the range of expectations. And I look back objectively and I'm like 50% revenue growth. That's fabulous. Those are terrific numbers.
Michael, I'm showing a chart here to our Bloomberg audience just of the growth really in those daily active users now hitting 210 million. What else do you need to see from this company to take on, bigger company like the likes of Twitter or an Instagram, for example?
What I've been seeing in terms of the proprietary research that we do, I'd like to see just a continued adoption of advertisers, where if you look at Twitter, Pinterest, Snapchat, they're still slightly more niche by way of comparison versus, let's say, Google and Facebook, where virtually everybody is buying. So seeing that continue to move in the right direction, continuing to see new ad product innovation, I think is key. But one of the things where I feel like I've gotten a lot of questions from investors is they want to understand, what's the opportunity in terms of advertising? Like chat probably is a slightly harder format to go ahead and monetize in versus, let's say, Discover, Lenses, Snap Select. And I think the message you heard pretty loud and clear from both Jeremy Gorman and from Evan on the call was this is a function of growing demand. There is more than ample supply, and I think there's really a lot of headroom for the story.
That was Michael Levine of Pivotal Research. Coming up, things keep getting foggier for WeWork's efforts to go public. News of platinum packages amid big worker layoffs and a SoftBank rescue plan. Details next. And speaking of going public, New York Stock Exchange President Stacey Cunningham joins me to talk IPOs and the rising inquiries around direct listings. This is Bloomberg. It is the end of one of the more dramatic business debacles in recent memory. SoftBank has come to the rescue of WeWork with a $9.5 billion package. We learned this week the Japanese conglomerate will get 80% of the office rental startup. WeWork founder Adam Neumann will walk away with about $1.2 billion. Last January, WeWork had a $47 billion valuation. Now the bailout values the company at less than $8 billion. Bloomberg Technology's Ellen Hewitt provided the latest on where things stand.
There's three parts. There's a $5 billion debt package. There's a $3 billion tender offer, about $1 billion of which is available for Adam Neumann to use if he would like to sell back his shares. That's up to him how much to take advantage of that. And then $1.5 billion of basically an accelerated warrant in which SoftBank is going to be taking even more ownership of the company, buying some more shares.
Now, the key here is SoftBank is coming in at a lower and lower average price per their transaction. So if there is a payoff, they could win big. But what do the other investors feel who are still bought in at these high prices and aren't participating in this lower round of shares?
This is going to be an ongoing conversation for WeWork and for the details, figuring out the nitty-gritty of this deal, because as you mentioned, you're right, SoftBank is doubling down on its ownership with WeWork and buying shares at a lower and lower price. In particular, this $1.5 billion of the package is coming in at much lower than even the tender offer. So they're snapping up shares. They clearly believe that if in the future this could end up being very valuable, that they'll come out with a win. At the same time, you have a lot of employees and other shareholders who are looking at these prices thinking, how am I ever going to get what I expected this equity might be worth? And in particular for employees who joined when they still got options, many of them are underwater. This is something that even came up today in an all-hands meeting with Marcelo Claure, who's now the executive chairman of WeWork. Employees are really concerned about how this is going to play out for them.
Describe some of the other reaction we got from employees when they heard about some of these bailout packages and some of these golden parachutes, if you will.
Yeah, in fact, one former employee even called it a platinum parachute for Adam Neumann. They feel like him walking away as a billionaire, I mean, to them it hurts. It feels painful that the company didn't even have enough cash to pay out severance packages for the thousands of employees they plan to lay off. And meanwhile, Adam Neumann walks away with, on top of his tender offer availability, a $185 million consulting fee, which at the all hands this morning, Marcelo explained to employees that fee was something they had to pay Adam to get him to agree to a non-compete and to remove himself from the board.
That was Bloomberg Technology's Ellen Hewitt. And coming up, we're not done with earnings. We hear from Twitter CFO Ned Siegel after the company reported Thursday and missed on revenue. We find out what happened. Plus, Micron's chief executive paints a rosy forecast on chip demand amid lingering hangovers from the U.S.-China trade spat. We hear from him in a bit. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs. Twitter shares plummeted into the double digits early Thursday after the company reported earnings that missed revenue estimates. It seemed that the company added plenty of new users, but struggled to sell advertising to market them in the period between July and August. I spoke all about that with Twitter CFO Ned Siegel.
I'd start by saying advertiser sentiment continues to be strong. But we did see more seasonality than we expected in July and August. And we also had a couple product-related issues where some settings didn't work as expected, which we realized during the quarter. That impacted us by about 3 or more points in Q3, and we expect it to have 4 or more points of impact in Q4.
So fixing those settings is good from the consumer, the user's perspective. How is that going to impact your financials, perhaps even more into 2020?
Well, we're working hard to remediate these things, and remediation first means communicating clearly so people understand when something didn't go the way we expected it to the people who were affected, to our other stakeholders. There were tweets about this stuff during the course of the quarter. Second is to make the setting work the way that we had expected it to. And then we work with partners and we think internally about the best way to make sure that we are giving people as good an experience as possible on Twitter, which means the tweets that they see, the ads that they see, that we're respecting the settings, but finding a way to give them a good experience. So an example would be we've got measurement partners who help advertisers understand the success of their campaign. We're working hard to get them better data that respects the user settings, but helps them understand if their campaigns are working as well as they thought.
A lot of people said that this was a little bit of one of the first signs that you had broken some trust with customers and that this was an opportunity for regulators to talk to you about data privacy. Have you been in touch with regulators about data privacy and controls over that?
Well, we're always in touch with regulators all over the world because it's an important part of us understanding their priorities, and it's really important for them to understand the principles that we use to make decisions about what questions we ask people, how we display our policies on the service, and how they play out in the product that we deliver. When we do that, we find we can come to better conclusions, and we can lay our policies out better for people, and they can understand our business better as well.
That was Twitter CFO Ned Siegel. It was a positive picture over at software giant Microsoft as the company reported first quarter growth in nearly every arena on Wednesday. Sales and profit topped analyst projections, lifted by demand for Azure cloud computing programs and the internet-based versions of the Office productivity software. I asked the Jefferies analyst Brent Thill for his impression.
The cloud, they're crushing it. It's absolutely incredible at $33 billion run rate that they accelerate actual constant currency growth from 15 up from 14 last quarter. And they have really embraced the shift to cloud. So both Amy Hood, the CFO, and Nadella, CEO, really got ahead of this, ahead of anyone. They're taking share from Oracle, IBM, many others in the industry. And we think that the momentum continues. What's notable is that they have massive backlog, meaning many of these contracts they're signing, they're not recognizing the revenue in the quarter. They're recognizing the revenue over multiple periods. So the future visibility for investors is incredible because these are multi-year contracts that used to be 10, 15, 20 million, now are measured in the billions of dollars. And that gives you future visibility. And that's why the stock continues to grind higher. Obviously, I think it's off a little given just the overhang across tech right now with Texas and a number of the other software names trading off. But overall, you can't dream up a better quarter.
That was Jefferies analyst Brent Thill. Chipmaker Texas Instruments struggled to allay investor concerns. The company posted a weaker than expected forecast on Tuesday. It's another sign that a rebound in demand for semiconductors will take longer than expected. I caught up with Bloomberg Tech's Ian King.
We're expecting things to continue to decline, but at a better rate. The declines would be smaller. And what we actually got from Texas Instruments was the reverse. Instead of being sort of a 3-4% revenue decline in the fourth quarter, they're predicting one as bad as 14% at the midpoint.
We had thought that a lot of their sales, about 56%, came from stable markets. You think industrials or auto sectors. Did any of that stability help them?
Absolutely not, no. Communications equipment was arguably their worst market, down 20%. Automotive was also one that they cited as being considerably worse, but they said pretty much across the board.
They do also lead some of the sectors in communications, like you'd mentioned. That's the one area where they don't have a lead. What can we expect from that company in the communication sector going forward?
Yeah, I mean, they weren't at all positive about that. Their chips are an important component of cell phone systems. So if you're looking for a read-through on whether the big telcos are spending on their networks, this would not be a good sign.
I want to pull in some conversations we've had about the trade tensions. We did hear from the CFO of the company, Lizardi, and I want to take a look at what was said.
The weakness is broad-based, is due to macro events, and specifically the trade tensions. And if you think about when there's tensions in trade and obstacles to trade, what do businesses do? They become more cautious and they pull back. And we are at the very end of a long supply chain, and when the ones at the very front pull back, it becomes a traffic jam.
So clearly putting a lot of the blame on trade, is that valid?
Two ways to look at it. Up until now, they haven't done that. They've been reluctant to assign blame, to say where this was coming from. Now they said, look, the evidence is just, we can't ignore it. And that, for him, was effusive. But on the call, they were getting a lot of questions along the lines of, look, the overall numbers in the market aren't that bad. How can you prove to us that this isn't you losing market share? Their answer to that was, look, market share in these markets we're in takes a lot longer to shift. Of course it's the economy. Of course it's the trade tensions.
That was Bloomberg's Ian King. As chip makers are still reeling from the U.S. trade war and the Huawei ban, Micron says it is focusing on a return to growth. I discussed this with the Micron CEO, Sanjay Mehrotra, on Thursday.
3D XPoint is a persistent memory. What we mean by that is that it is a kind of memory that is giving you faster speeds than NAND memory, than flash memory, and chip densities that are higher than DRAM memory. It is really ideally suited for data center applications, suited for both memory as well as storage. So this is to accelerate deep learning kind of workloads that require high speeds. What we introduced today is a solid-state drive that is the fastest drive in the world that we introduced. So very exciting.
Is this really banking on the future of the cloud?
3D XPoint memory is a technology that works well in data center applications. Of course, it is a technology that can also be deployed to other end market applications, such as mobile or other intelligent devices on the edge. But no doubt, data center is a big opportunity because the trends of artificial intelligence today are absolutely requiring ability to process a lot of data, gain more insight from the data, unlock greater value. That means you have to be able to have memory and storage solutions, which is what Micron makes. We are the only company in the Western Hemisphere that makes semiconductor memory and storage solutions. You have to store data, you have to access it fast, you have to process it fast. It needs the kind of solutions Micron makes. And yes, they go not only in cloud applications, data center applications, but all the intelligent devices at the edge, from smartphones to automobiles.
That was Micron CEO Sanjay Mehrotra. And coming up, first there was Spotify, then Slack. We hear from the New York Stock Exchange president, Stacey Cunningham, on the popularity of direct listings and the atmosphere in a delayed WeWork public listing world. And later, building habitats for space. We introduce you to one company building what may replace the soon-to-be retired International Space Station. This is Bloomberg. There's There's a growing chorus on the benefits of direct listings as an alternative to an IPO. That tune is being largely led by venture capitalist Bill Gurley of Benchmark. He is said to have planted the idea with Slack CEO Stuart Butterfield, which listed in June. Spotify led the trend in 2018, and so far Airbnb has also indicated it is leaning towards a direct stock listing next year. I caught up with the New York Stock Exchange president, Stacey Cunningham, on Monday.
If you take a step back and you think about why companies choose to go public, there are typically 4 reasons. 1 is access to capital so that they can raise some money. 2 is having the credibility of a public listing and the visibility of that event. The 3rd is liquidity for early investors and their employees who very often have been getting paid in shares or options of stock and want to be able to use that and go buy a house. 4 is currency so they can engage in M&A. Now, traditionally, access to capital has really been the primary driver in raising money. And what we're seeing now is for many companies, because they're much larger companies in the private market space, it's more the liquidity for their employees that's driving the public listing. So that allows you to ask yourself, can we decouple capital raising from a public offering? And that's what Spotify really started. Barry McCarthy, the CFO of Spotify, asked that question. He said, why do I need to go with the traditional IPO method if I'm not actually looking to raise money? And so that was really the genesis of the direct listing.
How does your role change between a direct listing and an IPO?
Our role, we've been at this for 227 years. We've been helping companies come to market so they have access to capital for a very long time. The IPO mechanism that we all talk about so much and are so familiar with has really only been around since the early 70s. So that doesn't change really our job. Our job is to help find price. We are uniquely positioned to do that at the New York Stock Exchange because we have a market maker that's assigned to trading each one of these securities. So with the direct listing, they're looking for that opening price in the morning to establish what the value of the company is and where supply and meets demand. And so that's the job we do here every day.
And you are in San Francisco because you're attending meetings and conferences about direct listings. In your conversations, what do you hear from underwriters who it used to be profitable to help underwrite an IPO. Now they're trying to get more involved in direct listings. What do you hear from those conversations about how they're trying to get more involved in direct listings?
I think they're trying to serve their customers. And as their customers' needs have changed, the banks are looking at how they can be helpful and provide resources to their customers. So they're very engaged on the process. And you know, we've seen them, you know, take a real leadership position on how we can use this as an additional tool, an additional product they can offer their customers. And that's what we're seeing happen.
You had said that you recently are getting more tech companies on the NYSE, which previously they were listing on the NASDAQ because you modernized your rules and you allowed non-profitable companies to list. But was that a good decision? Do you consider yourself perhaps maybe an enabler in some of those unprofitable companies?
Yeah, I think many people don't realize that the New York Stock Exchange listing standards didn't allow companies that were pre-profitable to list on the exchange. And many of today's companies over the past several years have come to the public markets prior to being profitable. And so we modernized our listing standards. And since then, the vast majority of tech proceeds have actually been raised on the New York Stock Exchange as a result. But the question that you're getting at is, are those companies good for the market? And it's very important for a company, you know, it's not unusual for them to be pre-profitability when they list, but then have a pathway to profitability. What's their plan? How are they going to get there? And investors can share in that process, and ultimately they do become profitable. And we've seen that with tons of companies out there.
That was NYSE President Stacey Cunningham. And coming up, private companies tap to create space habitats once the International Space Station retires. We explore the feat by one Boston-based company. That's next. This is Bloomberg. 2020 has been dubbed the year of artificial intelligence, and the multi-billion-dollar customer service company Teleperformance, it's headquartered in Paris, France, it's getting aggressive when it comes to AI, both in innovations and acquisitions. I got all of the details from CEO Daniel Julien Thursday from New York.
I don't know if I am going to speak a lot about our recent partnership in Nigeria, because it's a premiere for us in the country, and in fact it's much more to help to develop the sales than to help to develop the customer service in Africa. But what is sure is that all the companies all around the world now want to deliver a much better customer service to their customers, because the customers have taken the power thanks to internet and the smartphone.
And the idea of chatbots is very, very interesting. There was this statistic that we'd be speaking with chatbots more than our spouses. Do you see chatbots becoming more and more of your business?
You know, the first time I heard about the chat box, something like 4 or 5 years ago when it came, I was a little bit depressed, because my job is to have an army of service, of people helping the customer to solve their problem on the day-to-day. And I was thinking, my God, all these chatbots, they are going to do the job. And then that was 4 or 5 years ago. And guess what? Our company has never grown more than over the last 5 years. In fact, what's happening is the world is demanding, is more demanding every day. And so, yes, we need the chatbot to help. They are assisting bots that help our customer expert to better serve the customer. I would say the chatbot does the rational part of the job, brings information, but the customer expert, they manage the empathy, the emotion, because, you know, the customer is still a human being. Huh?
How are you also using AI and your business in content moderation?
In content moderation, I would say typically AI does and is relevant for 95% of the work. But still, AI has a difficulty in contextualizing and in understanding, in making the difference between what is offending, not offending, what is part of reality, what is part of a story. And so the role of the AI is to trim, is to I would say eliminate maybe 95% of the issues. The problem is that there are 5% of the issues that needs to be reviewed by human being. And this human being, by the way, teaching the AI to do a better job. But you know, it's a race that is never going to end.
That was Teleperformance CEO Daniel Julien. Finally this hour, over the past few decades, the International Space Station has allowed astronauts to live, work, and conduct research in microgravity. But with the station's planned retirement by 2030, private companies are being asked to create the next generation of space habitat. AI Space Factory, it's an architecture firm in Boston, proposes an idea to send a 3D printing robot to Mars, which can then harvest the materials found on the site to build the next generation of space habitats on Mars. It's technology on the cutting edge.
We will return American astronauts to the moon, not only to leave behind footprints and flags, but to build the foundation we need to send Americans to Mars and beyond.
This proposed mission, along with SpaceX's own ambition to reach the red planet, has opened up a longer-term market. And some companies are already thinking beyond orbiting habitats like space stations to actually building on the surface of other planets.
I was working in a firm designing skyscrapers, and I saw Elon, and he landed his Falcon X rocket in the middle of the ocean, and that for me was a trigger. I thought, wow, this could actually happen. And it's always been my dream to put a building on the moon or Mars. And if he's going at the pace he's going, it could definitely happen within my lifetime, and I want to be the one to build it.
In this warehouse, alongside startups from across the US, architecture firm AI Space Factory are refining the production of Marsha, a 4-story structure they created for a NASA competition to design the next generation of space habitats on Mars.
You know, when we started designing our Mars habitat, Marsha, I think we looked at everything that had been done already and kind of tossed that aside. But what we were given was a set of guidelines from NASA. They think the best way to build a habitat on Mars or the Moon is to use what they call in situ resource utilization. So use the materials that are there. If you've seen sci-fi movies, you might see like glass and steel domes on distant planets, but the reality is to ship that kind of material to the Moon or Mars would be so exorbitantly expensive you would never be able to build in the first place. So the idea is to send a 3D printing robot which can then harvest the materials you find on a site and build with that.
The reusable print material is a mix of biopolymer made from recycled plastic or plants like corn and sugarcane, and basalt, a rock found on Mars and Earth.
It's the rock that gives us its incredible strength. We've tested this material. It's 3 times as strong as concrete in compression, and it actually has what we call a tensile capacity. It can prevent itself from being pulled apart, which is something concrete's not very good at. You need to think at all times, how do you optimize the amount of material that you use? And that's also why this thing is shaped like an egg. And if you think of an egg, it's a very structurally optimized form. It's very, very thin, but it provides the strength that the egg needs. And that's why this is shaped the way that it is.
The egg shape, as well as the nested shell structure, also accommodates for extreme differences in pressure and temperature on the surface of Mars. But more research still needs to be done to find out how print materials could be gathered and how 3D printing would work in a unique environment of space.
You're dealing with a completely different set of physics and environments, which is very harsh. The cold, the low gravity, the vacuum of space, and finding solutions for how to build there or do anything in space just requires a high degree of innovation. There's no such thing as brute force when it comes to space. Like, you need to think about the problem, find a very elegant, lightweight, cost-effective solution. The next challenge is really going to places on Earth, literally taking the dirt that we're finding on a site and beginning to print with the dirt. We have to perfect this technology on Earth, and then we go prove it out on the Moon, and then finally onto Mars.
The first customers could include NASA and companies like SpaceX, who would lease out these structures for individual missions. But before that, AI Space Factory hoped their technology could be monetized as well as transformational here on Earth.
The challenges of building on Mars forced us to kind of make this jump in construction technology, which we can now apply on Earth, to build more sustainably. So rather than building with steel and concrete, which are these manufactured, very energy-intensive materials, to go to a site, have a solar-powered array that would then allow our 3D printer to print in the most sustainable way possible. And we never would have found these ways if it wasn't for the challenge of building in space.
3, 2, 1, ignition and liftoff of the Falcon 9 to the space station on the first commercial launch from Kennedy Space Center's historic Pad 39A.
That's part of our special Bloomberg original series, Giant Leap. And you can check out more on Bloomberg.com. And that does it for this edition of the Best of Bloomberg Technology, where we bring you all of the latest in tech throughout the week. Tune in each day at 5 p.m. New York, 2 p.m. in San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.